Hello, welcome back guys. In this video we are taking a look at WeWork. This is a company that has been going down as well. And as you'll see here, it provides flexible workspace solutions to individuals and organizations worldwide. Workstation, private office, customized floor solutions, amenities, services, private phone booths, and things of that sort for businesses, pretty much for enterprises. So, what is this company about in terms of its actual business? Are they doing well? Is that a good opportunity to buy right now? This is a very new IPO, as you'll see, 2020. It's a couple of years ago, basically. So let's take a little bit of a closer look at what is going on with the company here using our trusty stock analysis tool over here. You will see that actually pre-market is probably going to be down about 6% with the overall market. Futures are very negative right now. We are looking at a probable bloodbath again today after the Fed has announced a 0.75 increase in interest rates. So there was a little bit of a delayed reaction, which happens sometimes. It actually happened the previous time as well. Now, the stock has been down 64% almost right now. If you take a look at the 5-year chart, you will see that it has been a story of a decline here. But we do want to see whether after this kind of decline, it actually makes any sense to keep accumulating a little bit just to see what we can actually make out of this company in the long run. Okay, so if we take a look at the P ratio, you will notice that it is negative, and this is something that I don't like to see at all, because a negative P ratio means that the earnings are negative. The price cannot be negative, of course, and so the earnings are negative here, and the same goes with the price to free cash flow. About the same in terms of the pattern, really, as you'll see in terms of the chart. So at least the earnings and free cash flow seem to be aligning, but things are not looking great. The company hasn't been issuing too many shares, which is nice to see. That's actually a good thing. But the total liabilities to free cash flow is also negative. And if you take a look at the 5-year revenue growth, you would expect something better here from a company that is not making money. You would expect them to at least be able to increase their revenues at a faster pace, which doesn't seem to be the case. Now, their net income is actually going down tremendously in terms of its growth here. It's actually going down and down. So minus 175% decline over here, as you'll see, almost like a fourfold decline. I don't like to see that at all, of course. And it's only the total equity that has been growing a little bit. Maybe the outstanding shares played a little bit of a role here. But the price to sales ratio is kind of low here, which is good to see from a company that's not making money, but probably not enough. Now, the return on equity is 48 because the equity is positive here still. It looks like probably marginally positive in the last quarter or so, because overall it has been negative, as you'll see in the growth here. We can examine the finer details, of course. But overall, this doesn't look like a company that could be an interesting opportunity right now based on the initial financials that we're looking at here. If we take a little bit of a look at the stock news here, you will see that it's pretty much talking about some raising of new money here. Some hope, pretty much narrowing net loss, for example, offers some hope. So it kind of talks about more flexibility in working arrangements and things of that sort. But maybe it's not the proper time to be buying this stock. Now, in order to understand what kind of price we would be willing potentially to pay for this one, we always want to be taking a look at what the company is doing in terms of the financials, and also using our stock evaluation tool to deduce an actual potential price to buy this for. But first, let's take a little bit of a look at what happened with the financial statements. 1.8 in revenue to 2.5 in the last almost 4 years, and that's not great, as you can understand. You would expect this kind of growth company to actually grow much better, and it seems to be on the decline in the last couple of years. Now, that does make sense during the pandemic, of course, but overall it may be a continuation of a decline here based on the current work climate. So this may seem to be a little bit more sketchy than you would expect even for the future. And from 1.6 billion of a net income loss to 4.4 billion of a loss here. Now, if we take a look at the balance sheet, you will see that the total equity has been in the negative, although getting a little bit better. But if we take a look at the quarterly over here, which is the quarterly periods, you will see that the total equity has also been negative here. And so now you can kind of understand why this return on equity is positive, because we're talking about two negative numbers here. Remember that the return on equity is basically the net income that the company generates divided by the amount of equity that the company has. And so if both are positive, are negative, this is going to be a positive number. But obviously, as you can understand, with negative equity and negative net income, this is not a good thing to see. It's practically speaking a very, basically a number that you shouldn't be paying any attention to, because the company is returning negative, pretty much negative net income here. This is basically not applicable here. Now, if we take a little bit of a closer look at the cash flow statement, you will see that the net income again has been going down, and this is a bad start for the cash flow statement. And you will see that it's still in the negative, minus 1.9 billion here in terms of the operating cash flow that the company generates, while a lot of it is actually added back depreciation, amortization, and stock-based compensation, about $1 billion here. And some other non-cash items here, which are basically non-cash expenses added back here. They were excluded from the net income. They are added back here. These are one-off items. You're not going to be seeing the same item next, pretty much next fiscal year. Now, the free cash flow from minus 2.2 to minus 2.2. So basically the same story here. After 4 years of growth, nothing has changed, it looks like. That's not great to see. And if we take a look at the stock evaluation tool, what can you really do with this one? It seems to be getting worse in terms of the revenue. I mean, of course, it's the pandemic, but let's just say that we go overboard and the company does manage to go back to insane revenue growth, 20, 30, and 40%. And the net income margins have been solely in the negative, very much into the negative, because the company has been losing tons of money here, as you'll see. This is a company that I would have probably neglected to actually not even reach this stage here, the stock evaluation tool, because it's losing more and more money. I mean, you'll see minus 1.6 to minus 4.4. And regardless of the current situation with the pandemic, sure, that does take an effect. But I feel that it has caused a lot of damage to this company, and I wouldn't even know where the line in the sand is to actually invest in this one. So if you are thinking about marginal net income margins here, 1, 3, and 5%, and let's just go with free cash flow margin that is going to be the exact same. This is 100% of the net income, so it's basically 1, 3, and 5 of the revenue growth, pretty much, and annual return of 13%. Is what I'm gonna be asking for, just to see what we're getting out of this one. And it's a good thing that the current price is very low. It has fallen off a cliff, 5.44. It's actually falling more right now. We examined, it's gonna be 6% down. So this is probably heading to 5 or something of that sort. But remember, these high estimates here are very, very aggressive, super aggressive actually. 5% net income margin the company has never really seen here, and they're very, very far from it. They're actually in the negative, and so if you add the negative numbers here, you're not gonna get a positive result. And so even at this very, very confident stage here, you and these confident projections, you cannot really go with WeWork right now based on what they are doing and what they have been doing in the past. So I'd have to pass on this one. But I thought it's an interesting one to examine after it has fallen off a cliff. And it seems to be kind of a trendy company again, because it has fallen off a lot. It's not one that I would pick for a long-term trade, though. Definitely not. It's looking really, really weird here for holding for the long run, so not great over here. Okay, so thank you for watching the video. I hope you enjoyed this one, and I'll see you in the next one. Remember to leave a like and subscribe, and also if you want to gain access to this tool, you can find our Patreon link in the description box below this video, and just subscribe there, and you gain unlimited access. And thank you for watching again. I'll see you soon. Bye bye.